everyone, this is Professor Anderson, and this is your Chapter 1 recorded lecture. You should have in front of you a copy of the study guide that is the blank version of this so you can follow along and take notes, because just the simple act of taking notes and writing things down is a way to help you retain the material that we're covering. So let's start off by talking about what is accounting. Okay. Accounting is an information system that records transactions to produce financial reports. It's also referred to as the language of business. All right, it doesn't matter what field you wind up in the future, any sort of business field, whether you're going to be an entrepreneur or actually be an accountant, even if you're going to be a marketing major. The idea is that everybody needs to have some basic understanding of accounting because it is the language of business. You can't be successful in business without understanding what is on an income statement or what an asset is or what a liability really means. So we are going to go through all of these things together. And like I said, even if accounting isn't necessarily something you're sure about yet, you do need to have the basic understanding to be a successful business person in the future. But accounting, as I said before, is an information system where we're recording the transactions, and that's what we're going to be focused on through the whole first part of the semester to produce financial reports. Okay, and those financial reports are going to be the financial statements, and we'll get there. We'll get to them momentarily. Here's the full sentence from your book. Accounting is the information system that measures business activities, right? Processes the information into reports, as we said, the financial statements, and communicates the results to decision makers. All right, the way we communicate how a business has done during the year is to produce the financial statements. All right, and when we produce those financial statements and we put them out there for the world to see, that's how we communicate the results of the business's operations to the decision makers. Okay, who uses accounting information? Well, investors, right? Let's just go through a bunch of them. Investors, right? People looking to invest with your business. Creditors, people maybe you're looking to borrow money from. They're certainly interested in how well your business is doing because they want to get repaid. These are people in the capital markets, all right? The government is also interested in accounting information. The IRS is certainly interested in how well a business is doing. The Securities and Exchange Commission also monitors accounting information for businesses. Financial advisors, all right? Well, sorry, so investors, when I said investors, I meant like people loaning money to the business. Financial advisors are people looking to invest, like buy stock or something like that in your business for their portfolios. All right, stock analysts are looking at your financial information. They're looking at how well you've done from year to year, how well do you perform in comparison to your peers, things like that. Competitors, your competitors would be interested in how well you did too. So, for example, let's say you are Krispy Kreme Donuts, and you wanted to see how you compare to Dunkin' Donuts. That's your competition. Of course, they're looking at each other's financial statements and their accounting information to see how well they're doing against each other. The owners and the managers of the business are also interested in, Owners and the managers are also interested in how well a business is doing. Of course they are, because they are the owners, they are the management, they are running the business. They want to make sure that it's doing well. So lots of people use accounting information. These people are all referred to as stakeholders, right? Because they have an interest in your business. All right. All of these outside parties, right? These are all people outside of your business. When we refer to financial accounting, which is the title of the class, we're talking about producing financial statements and putting them out there for the world to see, or really for the public. These are all external parties. They're the ones who we are specifically producing the reports for, the financial statements. All right, and that is what we're going to be covering in this class, and it's all of financial accounting. The owners and the managers, of course, they're interested in as well in how well a business is doing. Of course they are. But really, when we look at how a business is run internally, that's really when we're talking about managerial accounting, which is something most of you will have to take in addition to financial accounting. There's usually a two-class sequence. First, financial, where we produce the reports that are called financial statements for the public. The second class you have to take usually in the sequence is managerial accounting. And managerial accounting is about the running of the business, producing budgets and trying to decide how much we should cost a product for, things like that. All right. Now, certainly, as I said, owners and managers are also interested in the financial statements, but really when we spend time focusing on just the internals of the business, that's referred to as managerial accounting. Okay, and that's next semester. Okay, well, who makes the rules, right? Accountants all have these rules we have to follow. This chapter, by the way, I didn't say it before, but this chapter is kind of a high-level view of lots of different pieces. So don't be too concerned if you're not fully understanding something that I'm talking about yet. We'll get to it in more detail in a future chapter. So like I said, this is kind of a broad overview. So one of the things we want to talk about is the hierarchy. Who makes the accounting rules? Who decides how we should be treating inventory, or how we should treat an asset, or what does a liability mean? Who makes those rules? Those rules are made by the Financial Accounting Standards Board, referred to as the FASB. Okay, the Financial Accounting Standards Board makes the rules, and those rules are called Generally Accepted Accounting Principles, all right, or GAAP. Those are the rules that we follow in accounting. The Securities and Exchange Commission is actually the ones who give the FASB the power to make the rules. All right, so SEC is kind of your overarching body that gives the FASB, the Financial Accounting Standards Board, the right to make GAAP rules, make new rules, and so on. All right, so there's my little arrow. Now these I want to call out, though, are U.S. specific. Nobody else follows GAAP but the United States. Nobody else has a FASB but the United States. Now, you might say, well, what does the rest of the world do? Well, what the rest of the world does is something a little bit different. The vast majority of the rest of the world follows something called the IASB, which is the International Accounting Standards Board. Right? You notice the terminology is pretty darn close, right? But the idea is that the International Accounting Standards Board then makes their own rules, and those rules are called IFRS, all right? International Financial Reporting Standards. They make their own rules, but you know what? They're not all that far off from GAAP. GAAP and IFRS have many similarities. They're probably more similar than they are dissimilar, but they have enough differences that they stand alone apart from each other. Now, when I started teaching probably about 20 years ago, let's go, I'm not that old, 10 years ago, 13 years ago, something like that. They were originally trying to converge the two. US GAAP was trying to kind of become one with IFRS just because, why not use what the rest of the world is using, right? Because the idea is if you were comparing a GAAP financial statement to an IFRS financial statement, there are enough differences that you would have trouble comparing the two. So, it's not apples to apples exactly. So the idea is that with IFRS, we were trying to converge them for many years, and at some point they just gave up. All right, the US GAAP, they didn't want to bend in places that IFRS, normally had certain rules. GAAP didn't want to give up their rules, and they just couldn't come to terms. They actually just started removing IFRS from the CPA exam because of this. But anyway, so the point is that most of the rest of the world, like the vast majority of it, follows IFRS. But the US is the US, and we know what's best, right? So we follow GAAP. Okay. All right. Kind of a different topic. What are the three businesses that operate for profit? Well, the three types of businesses we're going to be talking about in here are service-based businesses, merchandising businesses, and manufacturing businesses. Service businesses are just that. You're performing a service. Whether you're mowing a lawn or preparing a tax return for somebody, that's a service that you're providing them. They're not actually getting like a tangible product usually. A merchandising business, so really, let me step back for a second. The service business that we're talking about, we're going to stay with service through the first bunch of chapters. And then we're going to move into merchandising. Merchandising is when you're selling products that you haven't necessarily made. So that's your Targets, your Amazons, things like that. That's a merchandiser. Manufacturing, you're actually physically making the products. Okay. All right, so let's move on from here. Oops. I didn't have that pop up, but what are the four ways a business can organize legally? I'll cover this and then we'll stop there and we'll get on to a second video. The first way a business can organize legally is a sole proprietorship. It's one owner. If I wanted to start selling cupcakes out of the trunk of my car, I'm a sole proprietor. I can start doing that. Don't buy cupcakes out of the trunk of anybody's car. But the idea is that you can easily become a sole proprietorship. There's nothing involved. You just start selling whatever you want to sell. All right, that's a sole proprietorship. Partnership is basically a sole proprietorship, but two or more owners. A limited liability company, let me get back to that in a second. A corporation. A corporation is what you think of when you think of big typical corporations. You know, any of your really big companies that you think of the Microsofts, you think of the Mercks, any of those. Those are all typical C-type corporations. All right. A limited liability company falls somewhere in between. It offers some of the protections of a corporation. Don't worry, we'll get there. It offers some of the protections of the corporation, but the ease of ownership of sole proprietorship or partnership, meaning that it's easier to organize, but it offers you the protections of a corporation. So again, don't worry about that too much yet. We will get there. Okay. With a corporation issues stock. It is its own separate legal entity. So like Microsoft. Microsoft stands alone. I mean, I get that you think of Bill Gates when you think of Microsoft, right? But really, a corporation is its own legal entity. It can enter into contracts, it can sue, it can be sued, right? It is, once you form a corporation, it is its own entity, all right? The owners could die, Bill Gates could die tomorrow. Not wishing anything negative on him, but he could die tomorrow. The corporation would still continue, right? So corporation, you know, isn't tied to the life of the owner, whereas something like a sole proprietorship or a partnership probably is. Okay, oops. Let's talk some of the advantages of a corporation and why you would even want to be a corporation. Well, probably the single biggest advantage is limited liability. And what I mean by that is, let's say that I own a donut shop. Okay, I own a donut shop. I'm incorporated, Anderson's Donuts, all right? I'm incorporated, and something happens. I get sued because maybe my donuts made somebody sick. Oops. Maybe my donuts made somebody sick. They could sue my donut business because it's a corporation, it's its own separate legal entity, but they couldn't come after me personally. They couldn't come after my house or my children or my assets personally. So that corporate shield puts up a wall between the owners, right, Anne Marie Anderson, and Anderson's Donuts. It's its own legal entity. So the idea is that an advantage is there's limited liability. I can't lose, me personally, can't lose anything more than I put into the business. Okay, so that's one of the advantages of corporation. Unlimited life, like I said before, right? The ability to raise capital. It's a lot easier to raise capital as a corporation, meaning assets, right? You can issue bonds, you can issue stock. It's easier to take out loans, things like that if you're incorporated. Sell stock bonds. I'm getting ahead of myself. Some of the disadvantages of a corporation. There's a lot of rules. I can't just start selling cupcakes out of the back of my car, right? There's a lot of regulations involved with becoming a corporation. You have accountability, right? You have to produce financial statements. You have to, well, if you're public, you have to produce financial statements and they go out there to a public, you know, to the world to see once a year. You've got certain filings you have to do. It's expensive, right? You have to actually go through all the work that it takes to incorporate. The other thing is double taxation. Just know there's a disadvantage for now. We'll talk about that a lot more towards the end of this semester. Okay. Now, the idea of, this is a good segue, one of the things, the assumptions in your chapter 1, one of the things that accountants kind of assume is the economic entity assumption, meaning that a business is a sole proprietorship, it is a partnership, it is its own entity, all right? Business stands alone from its owners. For example, my donut business would not turn around and pay Anne Marie Anderson's mortgage, right? Once a business, it is a standalone entity. And when you report financial statements, it only is the data for that business, all right? Meaning, like, you've heard of things like people saying, oh, well, you know, my car lease is paid by the business. Well, that's not really very ethical. The idea is that unless you're using that car for business, it should not come, the business should not be paying for my car as the owner, okay? Your economic entity assumption says the financial statements and the income that the business makes and the expenses of the business are only for the business when you report them. They don't have any of the personal owner's information in there or any of that kind of stuff. So they live as their own entity once you create these things. Okay, I'm at 15 minutes, so I'm going to stop now and start again in a second.